Stable income, fragile collateral, the hidden fault line in the bond market. Flint West reporting. Most people think a bond is safe. They picture a polite little rectangle of paper that pays you on schedule, like clockwork, like rent from a tenant who never complains. And in one sense, that is true. But in the real world, a bond is not one thing. A bond is two things. And if you do not separate them in your mind, you will never understand why safe assets keep detonating the system. Because the bond market has a fault line running straight through its center. Stable income on one side, fragile collateral on the other. Same bond, different religion. Section 1. The pin in the map. Coupons do not care about the market price. Here is the first pin, the pin everybody misses. A bond coupon is paid on face value, not on the current market price. So if the bond has $100 face value and a 5% coupon, you get $5 a year. If that bond trades down to $50, you still get $5. The bond does not open the newspaper and say, wow, I'm down 50%, better cut my coupon in half. No. The coupon is a contract with the issuer based on par. The market price is what other humans are willing to pay today. So if you are truly holding the bond for income, and you can truly hold it to maturity, then daily price moves are mostly noise. Not nothing, not irrelevant forever, but economically irrelevant if you are not forced to sell and the issuer does not default. That is the clean foundation. Now we build the house on top of it. Section 2. The two cohorts. Cohort 1. The income holders. These people buy bonds like farmers buy land. They do not stare at the ticker every day. They stare at the calendar. They are saying, I am not here for the resale price. I'm here for the cash flow. Pay me my coupon. Give me my par at maturity. We are done. These are the stable income people. Cohort 2, the collateral users. These people do not buy bonds to own them. They buy bonds to unlock borrowing power. They treat bonds like keys to a vault. They are saying, this bond is not the meal. This bond is the plate. I am going to put leverage on it, repo it, swap it, margin it, roll it, stack it. These are the fragile collateral people. And here is the punchline. Income holders care about coupons. Collateral users care about price. Same bond, different physics. Section 3. Stable income side. Let us put real bodies on this side, not theory. First, life insurance companies. Think Prudential, MetLife, Northwestern Mutual, TIAA. These institutions are not trading bonds for vibes. They are matching long-duration assets to long-duration liabilities. An insurer has promises stretching decades, annuities, policy payouts, guaranteed benefits. So they buy long bonds and they match the bond coupons to those outgoing obligations. That is why they love the predictability. They often classify the bonds as held to maturity. Why? Because in their world, mark-to-market volatility is not the business model. The business model is collect predictable coupons, meet predictable liabilities. Rates can spike, prices can drop. On paper, it looks ugly, but the coupon checks still arrive. So in their lane, the bond is an income machine. Second, retirees and conservative investors using bond ladders. This is the I do not want drama strategy. A retiree buys a ladder of treasuries or municipals, one maturing each year or every couple of years for 10 to 20 years. They are not planning to sell them into the market. They are planning to live on the coupons and get par back at maturity. Market price fluctuations do not change the schedule. If you never sell early, you are insulated from mark-to-market noise. You might feel it when you look at a statement, but your cash flow is still your cash flow. Third, stable value funds and guaranteed investment contracts. This is the retirement plan with training wheels. You have a portfolio of bonds underneath, but it is wrapped in an insurance contract that smooths volatility. Participants see stable credited rates. The underlying bonds can move, but the contract absorbs the shake. That is stable income engineered. So on this side of the fault line, the bond behaves like what textbooks promise, a predictable stream of coupons and par at maturity. Now we walk across the crack in the earth. Section 4, fragile collateral side. This side is where the bond stops being safe and starts being structural. Because on this side, the bond is not held for yield. It is held for financing. And financing is a ruthless business. Financing does not care about your long-term story. It cares about your collateral value today. Collateral is marked, haircuts change, margins get called, liquidity gets demanded now. And when prices fall, the collateral cohort does not get to meditate through it like an insurance company. They get margin called into reality. First, United Kingdom defined benefit pensions and the 2022 liability-driven investment gilt crisis. This was the bond market screaming its true nature into a microphone. United Kingdom defined benefit pension schemes were hedging long-term liabilities with liability-driven investment strategies. They used long-dated gilts and interest rate swaps, and they used those gilts as collateral for leveraged positions. Then September 2022 hit. The mini-budget. Yields spiked violently, gilt prices dropped hard, and here comes the collateral physics. Prices down means collateral value down. Collateral down means margin calls up. Margin calls up means forced selling begins. Forced selling means prices down further, and the spiral tightens like a noose. Coupons on the gilts did not change. The United Kingdom government did not default. But the pension funds were hours from disaster because their financing structure was built on market value. The Bank of England stepped in with emergency purchases to break the loop. That was not a bond problem. That was a collateral problem. This content is brought to you by Bobby Giggs. Promote your brand here and reach a wide audience across platforms like YouTube, Instagram, and Facebook. Follow the links in the description to get started. Second, hedge funds and the Treasury basis trade. The March 2020 dash for cash. This is the quiet monster living under the floorboards of the Treasury market. The basis trade, in plain terms. Buy cash treasuries. Finance them in repo so the Treasury is collateral for borrowing. Short Treasury futures. Earn a small spread. Small spread, huge leverage. Because the whole game is safe until you need liquidity at the wrong time. March 2020, volatility explodes. Margins rise. Repo conditions tighten. Haircuts change. Funding costs jump. Now the trade is getting hit on two sides. Futures leg, margin calls, repo leg, financing stress. So funds sell treasuries, yes. Sell the risk-free asset into a liquidity stampede. And suddenly, you get the paradox. Even treasuries get illiquid. Prices drop. Spreads blow out. Not because coupons stopped. Not because the United States was about to default. Because collateral structures were being forced to unwind. Third, long-term capital management. 1998. The legend that taught the world a brutal lesson. You can be right in the long run and dead by Wednesday. Long-term capital management ran convergence trades with enormous leverage. Repo. Derivatives. The whole cathedral of cleverness. Then Russia defaulted. Markets went flight to liquidity. Spreads widened instead of converging. Now the repo lenders and counterparties do what they always do in stress. They demand more collateral. Margin calls flood in. Positions are illiquid. Selling moves the market against you. The spiral begins again. Coupons were not the issue. The bonds did not fail. The financing failed. The collateral failed. And the Federal Reserve had to coordinate a bailout to prevent contagion. That is the collateral side in its purest form. The bond is stable. The leverage is not. 4. The hybrid case. Silicon Valley Bank, 2023. Silicon Valley Bank is the perfect bridge between the two worlds. Silicon Valley Bank loaded up on long-dated treasuries and agency mortgage-backed securities when yields were low. In theory, that is the stable income story. Hold to maturity, collect coupons, get par back. Good. And Silicon Valley Bank did what many institutions do. They put a big chunk into held to maturity, which means they do not mark those losses through earnings the same way. So the statement can look calm while the market reality is screaming. But then the outside world changes. Deposits leave. A bank run begins. Liquidity is demanded. And now suddenly, the bank is not an income holder. It is a forced seller. And the moment you become a forced seller, your held to maturity portfolio transforms. From stable income into fragile collateral. Unrealized losses become realized losses. Confidence collapses. The market value reality that was irrelevant becomes the only thing that matters. Silicon Valley Bank shows the duality brutally. A portfolio can sit on the income side until liquidity pressure drags it across the fault line. Section 5. The contextual framework, the full map, not the headline. A bond has two layers of reality. Layer 1, contract reality. Coupon is paid on par. Principal is returned at maturity. This is the income layer. It is stable if there is no default and you can hold. Layer 2, market reality. The bond's price fluctuates with rates, risk, liquidity. This is the collateral layer. It becomes life or death when leverage is attached. Now, the critical distinction: income risk versus liquidity risk. Income holders mainly face default risk, reinvestment risk, inflation risk, opportunity cost. Collateral users face mark-to-market risk, haircut risk, margin call risk, funding rollover risk, forced liquidation risk. So the cleanest truth is this: income stability does not guarantee balance sheet stability. And the most lethal sentence in finance is, "We were fine until we had to sell." That is the fault line speaking. Section 6, the pinpoint position. Bonds are stable income instruments but fragile collateral assets. And the deep systemic implication: when volatility rises, the collateral cohort can destabilize the entire bond market through forced selling, even if the income cohort is fundamentally fine. That is why modern bond crises often are not about credit. They are about leverage, liquidity, collateral mechanics, margin cascades, repo plumbing, derivative exposure. The system breaks not because the bond stops paying. The system breaks because too many players treated safe as fundable at infinite leverage. Section 7, closing. So if you want to understand the next bond market blowup, you don't start with the coupon. You start with one question: who is holding the bond and what are they using it for? Because if they are holding it for income, the price is a mood swing. But if they are holding it for collateral, the price is oxygen. And oxygen does not get to drop 20% without consequences. That is the hidden fault line. Stable income on one side, fragile collateral on the other. Same bond, different world. And the moment the world demands liquidity, the bond stops being a sleepy income product and becomes a weapon pointed at the balance sheet. That is the map. Flint West signing off.